among ladies and gentlemen. I'm Hiral Dadia. We have with us Mark Mobius, co-founder at Mobius Capital Partners, joining in. Welcome to the show, Mark, and always a pleasure to speak to you and get insights from you. Mark, my first question coming to you is, overall, how are you reading the global situation right now? Because clearly we are talking of recessionary trends emerging out of the US, Europe. There has been political instability as well. There is trouble coming in China. How do you read the situation?
Well, I see a very almost tectonic change taking place globally, where the forces of an open society versus the forces of a closed authoritarian society are now clashing. And of course, we saw that now, we're seeing that now in Ukraine, with Russia trying to, using force to take over another independent country. And you're already seeing the problems in China, with China talking about taking military action against Taiwan. So these two critical forces are having an incredible impact. I mean, you can talk about inflation, you can talk about interest rates, all the rest of this, but the overriding issue now is this tectonic change that's taking place. And it's a big challenge for all of us of how to resolve these differences. I personally believe that you need to have an open society in order for civilization to advance. And I think probably a good example of that is India, where you do have an open society. You have a democratic system, however flawed it may be. Every democratic system in the US or anywhere else, you have a democratic system. It's flawed in some way, and it's messy, but it works, and it creates wealth. So I think this is really the big issue that we're facing globally. Now, beyond that, of course, you have inflation, but inflation is not new. You know, inflation comes from currency devaluation. And the reason why you have currency devaluation is that too much is printed. Governments don't give up on printing money. And that causes inflation. But this will come and go. And of course, interest rates rise because central banks believe that in order to fight inflation, you have to raise interest rates, which is why I've said that interest rates in America could go to 9% because inflation is now 8%. And the central banks believe that in order to solve inflation, you've got to raise rates above the CPI, the inflation rate. So that's where we are now.
Right. So overall, Mark, how do you see the Fed moving from here on? I mean, where do you see we can actually, at what levels will we see a pause in terms of the Fed rate hike?
There's only one way the Fed rates can fall is when inflation comes down. Now, if inflation begins to fall, then you will no longer see rate hikes, and you will probably see a reduction in the Fed rate. But as it stands now, we have to assume that the Fed rate will want to raise rates. The only current near-term wrinkle in this is the election coming up. I don't think the Fed will want to hurt the Democrats by raising rates at the time of the election to any great degree. So you may see a softening of their stance in the short term, but beginning next year, the race is going to be on again to fight inflation.
Right. So with all of this said and done, right, how are you reading emerging markets as well? Because clearly there are troubles coming in with regards to where China goes. By when they will ease off in terms of the COVID, restrictions is something we need to wait and watch. Additionally, the real estate crisis in China has also ballooned. How are you reading the China situation?
Well, because of the changes that have taken place at the Party Congress and the elevation of Xi Jinping to the utmost leader and maybe sort of a Mao Zedong status, things look quite difficult for investors because let's say, for example, China begins to attack militarily Taiwan, then you'll see the same scenario that you saw with Russia. First thing, there'll be sanctions put on China. anybody who has money in China will be in deep trouble because they won't be able to get it out. So these are the kinds of things we got to think about when we look at China. It's way beyond valuations of stocks and that sort of thing. Mind you, I do believe that the China market is very exciting, very big, huge potential, but you must take into account these overriding political factors, which could obviate any possibility of growth going forward.
Right. So do you think specifically from a manufacturing perspective, India is taking over a lot of business from China, which could be for the positive for India, but a clear negative in terms of the Chinese markets?
There's no question that, yes, China is going to be taking over more and more manufacturing, because you've already seen a move of manufacturing from China to Southeast Asia, to Vietnam, Thailand, and other countries. But these countries, the populations are too small to absorb the kind of work that is required. The working population in India is younger than the Chinese, and there's much more potential to grow in India, rather than China. So going forward, I think that you're going to see a migration of manufacturing to India. You're already seeing that, as you know. Apple and a number of other companies have moved into India to produce their products, and I think that will continue to happen, which is very exciting for India, because it means that more and more people will be working with higher and higher salaries, and the domestic market for products will be in demand, and prices will rise as a result.
Right. So if you have to advise an investor today, Mark, what would your advice be? Is this the time to start bottom fishing? Is this the time to start putting your bets, or would you say stay on the sidelines?
Well, you know, we have a saying, the best time to invest is when you have money. So what does that mean? It means that you shouldn't just sit in the bank, because that is not going to beat inflation. You've got to get into stocks that are growing. You know, good companies always beat inflation. Why? Because they have a pricing power. They're able to raise their prices in line or even in excess of inflation. And that's where you want to be, because that will preserve your wealth as a result of this kind of investment. So we advise people, go after companies that have a high return on capital, have low debt or no debt, and are growing their earnings in US dollar terms. This will be the safest haven that you can have. Of course, there'll be fluctuations in price from month to month, year to year, but at the end of the day, if you look at the history of investment in this kind of stocks, you'll realize that it's really quite beneficial.
And what are the sectors that you think would be growth drivers from here on? Because see, for example, if you look at in India, the banking sector was always under the woods for quite some time. Last 1 to 2 years, it's actually come out, and the state of the banking system has improved drastically, which we've probably never seen in history. So taking cues from there, what are the sectors of investments?
Well, I know a lot of people have asked about banks, and we don't go into banks for a number of reasons. First of all, these big banks, the strong banks, are in the index, and we avoid stocks that are in the index because they're already well known and well researched. We want to go into stocks that are not well known and not well researched, because we can then do the research ourselves and have some edge. Now, when you get into the smaller banks, there's a problem of transparency. In order to truly understand a bank, you've got to know what is the bad loan situation, and they usually don't want to reveal honestly, how many of their customers are not paying their loans. So it's a real problem with banks. But other than that, we're open to any sector. Really, you'll find we're invested now in India in a company that's doing raw materials for infrastructure. We're investing in a software company. We're investing in a healthcare company. So here in South Africa, we have a retail company that's doing very well in pharmaceuticals. So these are strong companies that are earning good money. Even after you've counted the devaluation of the currency, you're still doing very well.
Right. So, with all of this said and done, what would the entire geopolitical scenario, the entire, global economic scenario mean for currencies? Because we're already seeing what's happening with the pound. Simultaneously, a lot of reactions happening in terms of the euro versus the dollar. The dollar index reached a peak as well. How are you viewing the equation between major currencies right now and simultaneously its impact on the commodities market?
Well, as you know, all the currencies around the world are in trouble
Hmm.
against the US dollar. All of them have devalued to some degree or another. Very few exceptions. So what does that mean? It means that uh, countries that are importing raw materials are having trouble because they have to pay in dollars, and the dollars are not there or not there at the same rate that they expected in the past. So this means that the demand for commodities begins to soften. That's the reason why you've seen a lot of commodity prices level off or come down. Uh, the dollar strength has probably been finished. In other words, I doubt if you'll see the dollar index getting much more stronger from here, because I think the currency markets have already anticipated the decline and the devaluation that has taken place. So going forward, I think you're going to get a situation where many of these currencies will begin to recover. Now, of course, those currencies with high dollar debts are going to continue to be in trouble. Many of these countries will not pay their debts. They won't be able to do so, and everything will have to be rescheduled or paid off in currency that is devaluing going forward. But this is not alarming from my point of view, because a weak currency, as I mentioned, very often can be a good thing for a company that's earning dollars and having their costs in local currency.
Right. And overall, how do you see the bond markets performing globally as well? Because everyone's of the view, Mark, right now, that probably instead of actually putting in money in the equity market, it's best to invest in short-term bonds and then slowly, steadily pick it up from there to get into longer-term investments in the debt market. What would your view be?
Yeah, there are a lot of people who believe that it's a good time to go into short-term bonds with rates rising. Then they can just keep on, getting the upturn in the rates. I personally am not a keen believer in bonds,
Hmm.
simply because it's difficult for you to beat inflation as you would with a company that is growing their earnings higher than inflation. But of course, in some dollar bonds, depending on the risk, you see another problem you have with bonds is you've got to assess what is the risk and what is the chance of default. And this is a very, very difficult situation. But for those people who need a steady income now, then of course bonds that are paying a good rate of interest and are safe, are not going to default, might be a good thing. But I would prefer equities.
Right. And with the equity preference as well, I mean, most of the markets globally, yes, we are on a bear market. But do you think this is the end of it, or is there much more to this?
We already are in a bear market
Hmm.
around the world. You can see that. Maybe India is an exception, but most countries are in a bear market. And when you have a bear market like this, you cannot fix the bottom. We could have another 10% to go, another 15% to go, probably not much more than that. Uh, but in this kind of environment, it's a good idea to begin to look for opportunities. I'm not saying you throw everything in now, but you begin to nibble. And if the market goes down further, then you can nibble, take more. And once it begins to churn, one of the interesting things about these bear markets
Hmm.
is they usually don't last for more than a year and a half. And then the upturn begins. And you've got to be there when that upturn comes up, because you go from 1 to 2, that's 100% increase. It's not you're not going from 100 to 110, but you're getting an incredible upturn. And that's where you want to be.
Right. And my last question, Mark, coming to you is, you already mentioned in terms of as a market, if you were looking at India, what are the sectors that would be your focus? Now, you mentioned about software companies, you mentioned about, raw material companies into who are providing supplies to infrastructure. Anything that you would have in terms of the healthcare space, say, from hospitals to diagnostic chains or to any other pharmaceutical companies?
I think the diagnostic chains are quite interesting. That would probably be an area where I'd look at. But further afield, I would say that going forward, that a lot of the consumer names in India are going to be interesting because consumer spending will increase as a result of the rising incomes and young population. So I think putting that all together, there are just opportunities all over the place. But as I said, you got to stick to those criteria of high return on capital.
Right. And very lastly, Mark, your one bit of advice that everyone always wants to hear, what would that be as an investor?
Be happy, be optimistic. The world belongs to optimists, not pessimists.
Absolutely. Thank you so much, Mark, for speaking to us. Thank you. Stay safe and
Thank you.
speak to you soon again, and wish you good health.
Thank you. Bye-bye.
Bye-bye.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.